A bunch of global analysts call the current up move a move before the storm hits again. Could that be the case? And could Indian equities be different in such a scenario? Of course, geopolitics is the top of mind with all that's happening around China and Russia versus the rest of the world as well. So let's put all of that into context in today's show of Talking Point. I'm your host, Neeraj Shah, and our guest today is Mrinal Singh of InCred. Mrinal, great having you. Thanks for joining in. Hope all is well.
Yeah, all is well. Thanks. It's a pleasure. All is mine.
Yeah. So, Mrinal, have you been constructive of late, or are you circumspect about the current up move? And you believe that at some point of time, the banking crisis and geopolitics will ensure that markets don't go up, or rather, the markets come off again?
So, in my view, the markets are reflecting the changing landscape both globally and domestically. We seem to be obsessed with tracking the index, but then the reality is a lot is changing beneath that number. For whatever levels of market that exist today, or maybe 2 months earlier where they were low, there is a significant dispersion compared to those numbers in individual stocks and sectors and businesses. So to be specific to your question, Neeraj, I'm finding pockets of interesting value even at this level, and I'm also finding some pockets which I, even after correction, don't look appealing to me. But broadly, let's say compared to 3 months ago, 6 months ago, a year ago, there is a larger set of businesses that seem to be appealing in terms of the risk reward, particularly if you're a long-term investor and from a fundamental perspective. Yes.
Okay. Mrinal, have you been a GARP proponent all through? And if not, have you changed the buying style in order to suit the current scenario of higher interest rates than what they have been for the preceding 15 years, so to say?
So very interesting question, Neeraj. In fact, zebra doesn't change stripes, neither does tiger. So the reality styles don't change. We adapt. Most mature investors are very well aware about their investing style. They also know in what phase of the market they will struggle as well as they will do well. So high interest rates and higher inflation, or let me use the word elevated interest rates and elevated inflation, is not something new to our market. Last time we saw that was in the era of 2010 to 13 all the way. Again, crude led at that juncture and commodity inflation led. So, well, for people who've been around for 15, 20 years, they know what exactly it means for investors, for the general consumers, and for businesses. So that's nothing new. It just has been a long period of time since we've not had that. So I would assume that a new set of breed of investors wouldn't have seen that practically. They would have read about it, but then people who've been around for 15, 20 years are actually aware what it takes.
Yeah. Okay. So you have been a GARP proponent all through, I take it.
Yeah. So more value oriented, frankly.
More value oriented. Yeah. Got it. It's interesting, Mrinal, just off topic. There's a tweet that I read today from a Bloomberg anchor called Tracy Alloway in the US, who said that I know that I'm earning below inflation, but earning interest on money placed in the bank is something that is really new and I'm enjoying it. I was like, hey, India is a different kettle of fish altogether, but yeah, for the Western markets, I guess it's a pretty new feeling. So therefore, Mrinal, do you reckon that the Western geopolitics, you could argue that there has been some border provoking by China when it comes to India as well, but nothing alarming, I reckon. But the Western fault lines, Russia, West, China, US, all of that, plus the fact that crude is now starting to inch up again based on what OPEC Plus has done, do you reckon that puts a lid on the upside or not really?
So it always keeps the market worried. So let me put it this way. The current state of the market is such that it is going to respond with a higher amplitude to a negative news item compared to a positive news item. And that's to do with two key things. Geopolitics and fault lines is one, but I think more important than that is there is a legitimate alternate for global capital to earn return, which wasn't there for last 10 years. So if you are a US based investor, you could typically earn between 3.5 to 5 based on what kind of horizons you have on fixed income. So pension funds, endowment funds, they actually for a long period of time had no option but to take risk. That landscape has changed. So there is, I would say, a withdrawal of capital from risk assets, and the geopolitics has become more volatile. So I think that is why the markets are currently in a phase where clearly they respond with a higher amplitude to a negative stimulus compared to a positive stimulus. So which will mean that it will be a high volatility induced phase, which actually is very good for long term investors. So I really think that that creates very interesting entry prices if you're patient, if you know how to make the most of it, and could be very rewarding. And we should thank our stars. We are in an economy which is going to grow. If you were in Japan, let's say, I mean, you would think otherwise, but we are going to grow, and volatility and that too external in nature will only throw interesting prices. So all it takes is, stick to the basics, have the patience, keep your temperament for buying at the right prices, right businesses, and just be patient, and I think it should be all right.
Interesting. Okay, so let's talk about some of these pockets, because I heard you in your opening answers talk about how there's been a wide dispersion in individual pockets, never mind what the index may have done. Now, I was thinking of IT today morning, of talking to you on IT, also because of the fact this, for example, a JP Morgan note today which says that there might be a negative catalyst. I mean, they open a negative catalyst watch on HCL Tech, citing that the company may guide much lower than what the street estimates. And we could well see that happening for some of the other firms as well, Mrinal, because it's difficult to figure out how is it that US banks will give them a robust picture of what the next 12 months will throw up when the IT firms are going to give out their guidance for the year. Now, my question to you is, could a quarter of muted guidance or not enough confidence on what the year will look like bring about a correction in the IT names? And could that correction, or will that correction be viewed as an opportunity by you, or are you bearish on IT person?
So, well, a correction in IT names led by some kind of US concern or issue or some kind of movement in those markets will definitely be a buying opportunity for us. The IT stocks are, in my sense, largely a tad below where I would say, that they are in the value zone. They are a little above that. But then that's because there are genuine reasons to be concerned that, because most IT companies, barring a few, have almost 40 to 50% of their revenues coming from BFSI space and largely North America. So there is good reason to be cautious about it. Market has actually brought down prices with that fear and concern. But then I would say a dip for any reason could be interesting. We could choose our names based on valuations and based on fundamentals. That's how we would place ourselves. But then we do find some interesting domestically oriented business which look far better. But then I would not call ourselves as bearish on IT, no. But we would definitely be more choosy on IT prices given the landscape. I think we might just get, if you are patient, we might just get very interesting prices.
Okay. And I'll come to that domestic conversation in just a moment. But one more follow-up question there. And Mrinal, I'm not asking you to talk on a stock per se, but I'm citing that as an example. Like day before yesterday, on one of the most expensive ER&D names, JP Morgan again came out with a note on KP. I think they came out on the note on ERD. They said that, a stock trading at such high valuations is bound for disappointment. Now, proponents and on social media, it was agog, it was a wild topic of discussion. The proponents of some of those businesses argue that if a business is growing or showing promise of growing 20-25% for the next few years, why shouldn't, even if it's an IT business, why shouldn't it have such high valuations, considering the fact that we have a bunch of other consumer names which are not even growing at those levels, but still trading at those expensive valuations? I would just love to understand, how would you read into the argument? Ignore the stock completely.
Yeah, so the space actually, it's actually not fair to say these companies are IT companies. They are actually IT enabled companies. They are more in engineering design. So very often, and I've seen that in 2008 and all the way subsequently, very often they get clubbed in their correlation, both positive and negative, with the IT names, because that's how the local market has generally been seeing them, although their business is completely distinct with a very different set of characteristics and clients. So, well, I would say IT, ES, or engineering design services has a significant large roadmap because manufacturing globally is actually shifting locations. And there is a huge disruption, particularly in auto, because things are moving into greener ways of mobility. Is it electric? Is it hydrogen? It's the jury is still out. I would be more constructive on engineering design names, but we have very few pure play engineering design plus large engineering design names to choose from. But we do sporadic few small and mid names, which we find interesting. In fact, we are seeing a trend where large auto companies which had in-house engineering design businesses are outsourcing this to cut cost, and there is a significant ramp up in that manpower for either captive or even outsourced vendors in India in particular. So I think that space has long legs. Definitely looks better than vanilla IT, at least in the near term.
What about the valuation argument, though, Mrinal? Would you buy an ERD company which is growing at, say, 15, 20, 25% for the foreseeable future at sky high valuations, or would you not be comfortable?
So, well, I belong to a school of thought where valuation is paramount. So, high growth companies, but the risk reward still has to make sense. But sky high valuations don't make sense in any business, no matter what the growth is. That generally historically hasn't been very rewarding.
Okay. So how are you approaching domestic consumption then, Mrinal? Because a bunch of those domestic consumption names are still, despite the 1.5 year of zero movement, are down, right? Are still expensive.
So excellent question, Neeraj. So let me give you the holy grail of investing in elevated interest rates and elevated inflation. There's only one thing that matters. If for whatever reason we just imagine that things remain elevated on both interest rate and inflation for let's say a year or 2 or 3, the business which can grow volumes will significantly deliver value. So volume growth is what you need to chase, and that is what matters. So even with high prices and high interest rates, if your business can deliver volume growth, that means whenever things normalize on the negative side, it would have gained significant market share, and on individual SKU level, it would expand profit, and the profit that it will create would be far larger than what the street and Excel will estimate. So what we need to figure out at this juncture is who's going to grow volumes irrespective of what we see in on the interest rates or inflation. And that is easier said than done. You need to have a brand. So B2C, ability to pass on the price increase, ability to control the raw material inflation. So this needs a very strong trait on the business, debt-free ideally, ability to have negative working capital. So a lot of these things, too much to ask, but then you do get quite a few ticks on some businesses, and at times B2B businesses as well, which are just simply adding value of a significant. We have seen such phases in the past has created behemoths when it comes to outsourced business. I saw some chemical companies making the most of it in the 2005 to 10 era. A lot of global outsourcing happened in that, and they gained size, and then now really big of a global nature. We'll see a lot of the. See, let's not forget, PLI is creating or attracting large investments, and a lot of these investments are actually, beginning with assembly of sorts. But then eventually the ecosystem of the entire vendors will happen here, and this will be large businesses. So I guess inflation is here to stay for some time. The crude is there elevated. Interest rates are not going down anytime soon. That's what it looks like. The regulator is saying that higher for longer.
Yeah.
We've seen those things in the past: volume growth, price leaders, leading brands, opinion makers. This is what we need to choose. So B2C, just because you're B2C cannot command premium. Ability to grow volumes is really what matters. So businesses which can grow volumes even in this market are definitely geared for something really big in the future.
Okay, I heard you say that there are some businesses which are ticking most of the tick boxes or the most of the check boxes. My question is, in the current scenario, are businesses which are checking most of those check boxes available at a good price for you? If so, what are the pockets where these are available? We can't talk individual stocks, but maybe you can just tell us which sectors do you find such opportunities?
Excellent place is to look for rural consumption plays. rural has done so bad in last 3 years. Post COVID, rural economy did not recover at all, and something or the other kept on hitting them. Now we are at a cusp of an election year where rural spending picks up, things have bottomed out. So look at the commentary of the staple companies. They all are saying rural has bottomed out. So rural consumption is a great place because a lot of businesses have significant distribution reach in rural. That includes FMCG, that includes auto, both two-wheeler, four-wheeler, and prices are all over the place from 50p to 15p. Everything is there. So based on what style you think you have, you could choose. I think rural consumption is going to come back. If the rains are good, we will see things looking back on that side, because the next 18 months we will see rural spending. It always happens in a run up to election. In any case, rural is more or less bottomed out. The commentary of the businesses is clear. So I think rural is a place to consider investing into.
Okay, my final two questions, Mrinal. One is on banking. The updates received thus far don't actually seem to be pretty good. I mean, HDFC Bank really performed well. The others were maybe moti in line, but relative to the fact that the expectations were high, the delivery isn't faltering, although it's very initial days. My question is, are you constructive on banks per se for the next 4, 5, 6 quarters because of the expectations of the kind of credit growth that they can deliver, or not quite?
So, well, very interesting place. Banks actually are, for what they're delivering, you would normally expect them to respond better on the stock prices, but it's an overcrowded trade. And it's overcrowded trade because it's almost 40% of the index. Everybody who is invested in India, from foreigner to domestic, is invested there. So there is no incremental buyer who's coming across. Now that is what is causing the problem there. Otherwise, if India is going to grow, why will banks not grow? They will definitely grow. I mean, the measure of growth could be different, but then they are a second order play on the economy, and India is going to grow. But being overcrowded, overowned is what is hurting them. So I guess we should have moderate expectation of return, not because the businesses won't deliver, but because they are largely owned, and there has to be a large incremental buyer. So FIs have been largely selling, so that creates pressure. For every 100 rupees they sell, anything from 30 to 40 is banks. Banks continue to do fine. In fact, the balance sheet of banks is far better than what it used to be. The NPA levels are the best we've seen. The growths are picking up. After almost a decade, we are seeing credit growth, and that too from MSME, which is very good sign. So everything is in place. The banks don't seem to be moving fast enough. For most investors, it gets frustrating, but it's not surprising. But we need to recognize, and this is again going back to the point that I mentioned, 15, 20 years would have taught you this. We are in not a capital surplus environment. We are in a capital constraint environment. So, over-owned, meeting expectation does not deliver return. You have to be under-owned, and beating expectation is what makes you money. So there is a change in the threshold.
That's the most powerful thing that you've said, Mrinal. Thank you so much for that insight. My final question, really, and that is on a note that I read from I think Jeffries today, which pointed out that their assessment, of course, that their checks of the property consultants, seems to make them believe that pre-sales in Q4 will be high, and luxury demand has still not stopped despite higher rates. And therefore, when the turn on interest rates happens in India, not tomorrow, but whenever it does, these pockets, which are probably not over-owned now anymore, maybe under-owned, and available at a good valuation, might actually be great pockets to look at. Do you concur, or do you have a different thought?
So I'll just look at data. I'm not an expert on property, and I don't think buying property stocks through equity is a great idea either.
Okay.
But then if I look at the data, the clearly inventory is, or finished good inventory is more or less vanished. So that has happened. So we now largely are talking about WIP inventory. I've historically seen that interest rates or home loan mortgage rates have no great correlation with demand. In fact, income growths have far more. So new buyers don't look at home loan rates to buy. They look at the property prices and look at their jobs and see that, okay, we'll be around 10 years in a job and incomes will grow. That is what decides them to buy. The home loan rates are actually, then once they've made up their mind, they've narrowed down on a property, that is when they start looking, okay, which is the cheapest home loan available. It's just because things are 0% on home loan or 20% on home loan, that doesn't stop people from buying. Actually, their income growth outlook and the property prices is what makes them buy. The runway for housing demand in India is so large. I mean, there are so many ways to play it, be it cement, mortgage, I mean, plethora of it. It is by far the largest employer in this country. If there is one sector that matters, it is housing, because it really moves the needle in terms of employment and growth numbers like nobody else. I mean, cement, steel, labor, credit, sanitary pipes, you name it, and all of it is domestic. So that sector is always going to be a darling for policymakers. And no surprises, you get income tax breaks to buy a house and whatnot, because this can significantly move things in the positive trajectory. So, well, as growth happens, as incomes improve, I think we will start seeing that reflection on demand for housing. And current data is clearly pointing that the finished good inventory is getting absorbed. It's largely finished, at least in larger pockets. Now there is demand for more housing, and we are going to see uptick in the housing, no doubt about it, clearly. And we have never grown. Look at all the growth decades of India. We've never grown in absence of housing. It doesn't happen that India grows and housing doesn't grow. And we are now at the back of almost 7-8 years of no price movement on housing, and largely in a very beneficial way. Consolidation, as they call, large amount of consolidation has happened. Prices have gone largely nowhere. All the NPAs are done with. RERA has come into picture. So for consumers, it is far better. Whatever builders had to close shop or go into NCLT, all that has happened. And I mean, so the market is ready.
Okay, let's see if it does deliver. But Mrinal, great talking to you today. Thank you so much for being with us on Talking Point, and have a great week ahead.
Thank you. Thank you so much.
Viewers, thanks for tuning in.